Hello and a warm welcome to Money Mind. This week, the United States goes to the polls. What will the results mean for investors and markets around the world? But first, here are the top 5 business stories you need to know this week. The U.S. economy grew at its fastest ever, expanding at a 33.1% annualized pace in the third quarter as consumer and business spending soared. The advance estimate beats expectations and comes after a record economic slump in the second quarter due to COVID-19. China is aiming for sustainable higher quality growth in the next 5 years, but it did not specify a growth target. At the conclusion of a 4-day meeting, Chinese leaders stressed self-reliance in technology as a key growth engine with aspirations for major tech breakthroughs by 2035. Investors in China rushed to get a slice of Ant Group's initial public offering, pushing its retail book to be many times oversubscribed. Singapore's central bank says the current downturn is likely to be more protracted than previous recessions. In its half-yearly macroeconomic report, the Monetary Authority of Singapore says growth momentum in Q4 will slow and remain modest in 2021. Singapore is opening its borders to visitors from mainland China and the Australian state of Victoria. Singapore will also allow its residents to travel to both mainland China and Australia. The clock is ticking down to the U.S. elections, and whatever happens on November 3rd will ripple around the world. So today we take a closer look at how this will affect your money matters. Joining me for the discussion, Gary Dugan, the CEO of the Global CIO office here in Singapore. Hello there, Gary. We've got Waqas Adanwala, Asia analyst at the Economist Intelligence Unit, also here in Singapore. And Cole Smead is the president and co-portfolio manager at Smead Capital Management. He joins us from Phoenix, Arizona. Gentlemen, thank you very much and welcome to the show. Let's give the first question to Gary. The election polls seem to be indicating a narrow lead for the Democratic candidate Joe Biden, but we also understand that the pollsters got it wrong the last time round at about this period. What is the likelihood that history could repeat itself?
I think it's unlikely. Let's hope that the pollsters learned from last time round. And I think the polls last time got the percentages right. So Clinton did eventually come in with a 2% majority. Adjustments have been made. And I think if you look at Biden's lead at the moment, it seems to overcome all of the inaccuracy that pollsters probably bring. So I think you've got to be relatively confident. I would say 80% confident that Biden wins with these polls.
Waqas, there's plenty of stake in every election, as we know. Would you think that this time around the stakes are particularly high?
Well, it's definitely an unprecedented election. Unemployment rate was quite low at the start of year, but that has skyrocketed. So in the downturn of an economy, when you have racial riots, when you have a pandemic, and the society in general is very polarized. So all these factors together do make this election rather special. In fact, a big chunk of Americans do think that this is a battle of the nation's soul. So definitely, we will be, seeing a very, very interesting outcome in that sense.
And this question for Cole, you're at the source in the U.S. itself, in the state of Arizona. And we do know that Arizona is known to be a Republican state. Only one Democratic candidate's won in the last 70 years. That happened to be Bill Clinton. Now, President Trump looks to be trailing behind Joe Biden in Arizona. What's the cause for this shift of mindset?
This is an electoral college. As Gary was saying, it's not a popular vote. And the dangerous part about paying attention to national polls is you have to remember in large electoral states like California and New York, it's incredibly skewed voting. 70-30 is the mix of those states. And what that does is that means they're pretty meaningless for the electoral map because you know they're going to go Democrat every single electoral term. So like you said, the states that are in play and are going to be the interesting ones to watch will be Arizona, it will be Wisconsin, Michigan, kind of the Rust Belt states that were left. I don't see it as being wholly different than the prior time. I think we're more aware of the biases that the pollsters had, but it looks like a complete toss. The pandemic does change a couple things. Early voting is going to be more common this time. So it will really come down to which party got people registered to vote and get them excited to vote, much like it always is.
And this one's good for all of you to address. What happens if there's no real outcome by Inauguration Day? Gary, would you like to start with this?
Would be a disaster for the markets. I can't believe that we'd really go through, 2.5 months of legal argument. One hopes that, I'm assuming there will be legal arguments irrespective of the outcome over the first few weeks. And but things should shape up by the middle of December. So we hope we don't go all the way through to inauguration and that things are clarified before then.
All right, Wakas, have you factored this in at all? A cold January without an outright winner by then?
I do think that yes, by the end of December, we will see an outcome. But this is again a risk we have factored in into our reports and to our views that yes, potentially by January, you could see a constitutional crisis. That would be a disaster for all the safe haven markets, obviously. So yes, you could see a lot of disruption, not just with the financial sector, but potentially also a future lockdown in government, because how would the Congress respond to that? So there could be further disruptions in policymaking front too.
Cole, people are really thinking about this, the possibility of no outcome.
Yeah. And last time people thought about there being a tied electoral map and we got nowhere close to that either. So I think that's a very unlikely event. You got to remember back in 2004, Kerry and Bush faced off. We had hanging chads in the state of Florida, and that did cause things to prolong. That was the closest to a situation where you had a presidential race hinging on one single electoral state. But that has been an outlier historically. What you're more likely to see is an obvious advantage in the first night, and it'll probably be done by the following morning or the following day.
Well, we're going for a short break, but still ahead on the show, we will take a look at the state of play in the U.S. economy and what's in store for the next administration. Welcome back to Money Mind's special virtual panel on the U.S. elections. The coronavirus outbreak triggered record contraction in the U.S. economy this year and has led to millions of job losses. And while some countries around the world have kept COVID-19 cases down, the U.S. remains a hotspot. Gentlemen, once again, thank you for joining us on Money Mind. Wakas, this one goes to you. Will the pandemic continue to put downward pressure on the U.S. economy? What headwinds are there?
Unfortunately, the pandemic will remain a recurring theme in the minds of people. It will weigh down on consumer and business sentiment. And until and unless you actually have a vaccine which is commercially available to the wide parts of the population, you won't really see a full stage recovery. Because again, the hit from the pandemic was a sharp one, but recovery is only going to be gradual and staged. Not all sections of society will be able to reopen as immediately as they were able to shut down, such as travel and tourism, for instance, or others in the retail sector. Yes, some sections might have gains, such as online sales or in general tech sector, but not every sector has been able to benefit as equally. In fact, they have actually suffered far more.
Cole, in Washington, there's lots of talk about a stimulus package. It's been somewhat frustrating with a start-stop process and so much uncertainty. What's it going to take to get some action going in that regard?
I think it's pretty unlikely you'll see a stimulus bill prior to the election. It probably won't be till a new regime has come to D.C. But if you look at the recovery so far, housing and autos have led this recovery and really shocked the economists at this point. And I say that because if you go back to 2008, 2009, those sectors never recovered in the economy for years. So we're having a classical economic recovery. And despite the fact that there is no stimulus, the jobs number continue to surprise the economists who are giving two-handed answers all the time.
And Gary, looking at the economic and tax plans of Trump and Biden, which do you suppose would be the most beneficial for business owners and the economy in the U.S.?
I think both would argue that they have the right policies, but to take them one at a time, I think you just get more of the same from the Trump camp. Clearly, it's big business. Clearly, it's not green. But there are a couple of plans that have not come to fruition. One is one on infrastructure, which is still desperately needed across the world and in the United States, and a healthcare plan. Looking at Biden, you've got a commitment to $1.3 trillion of spending, particularly on green issues and health elsewhere. But the sting in the tail is that he's also going to be increasing taxes, at least for the higher paid and for the corporate sector. So maybe at a margin, the stock market would prefer the plan from Trump over Biden.
All right. And staying with you, Gary, what would it take to get a swift recovery of the U.S. economy? I can think of one. The virus has to go away.
Yes, the virus certainly has to go away. But as Cole was suggesting, there is already perhaps quite a significant underbelly of good news coming out of the US economy, and it just needs to be reinforced. So people are buying cars and homes because they think their income is going to remain intact. And therefore that can be boosted further with an effective fiscal boost to come through. Let's just say in the region of around $1 to $2 trillion. And in the background, we still have considerably, these very, very low interest rates, which are a significant stimulus in themselves. So I think there will need to be more spending to reinforce the underlying trends.
All right. And Cole, reinforcing that good news, is that enough for that swift recovery?
Well, the recovery is well on its way. And I think investors are scared of the economy, and they shouldn't be scared of the economy. I think that's the big mistake. And let me just give you an example. If you look at the U.S. household debt service ratio, which has been tracked by our Federal Reserve since 1980, you'll find that we have the least amount of gross income going to debt payments of any form. It's an all-time low as we speak at this hour. So Americans can borrow in a way they really haven't had room to. The peak of that was in 2007. And so I'm completely confused that we couldn't have better footing, and yet people are scared. When we borrow a lot of money, that's when you should be scared. And we're just so far from that. The stock markets look far more dangerous than the economy. The euphoria we're looking at right now has to do with a very narrow U.S. equity market being dominated by a handful of outstanding businesses. And then secondly, you have IPO issuance, and you have SPACs raising billions of dollars every single day right now in U.S. equity markets, which is typically indicative of these type of speculative financial euphorias. And you put that together with a stock market that's produced the kind of returns it has, and those never end pretty.
Wakas, any thoughts on recovery that could possibly be swift down the road?
Well, we actually don't see the economy recovering to pre-coronavirus levels until mid-22, to be fair. Recovery is going to happen in 2021, but again, it won't be as swift and as fast as you imagine it would be, because borrowing levels may be low compared to GDP ratios, but again, are people confident enough to spend that money? A lot of the money that was given to the people in form of stimulus forms was used. It helped to prop up their incomes for the time being. But if those measures are not propped up for the long time, that will actually cause problems. So it's more about the confidence in general. Yes, you may be buying autos, you may be buying cars, but then is the entire economy, benefiting evenly, or is it actually, again, a split recovery in a K-shape?
Gary, would you have some thoughts to share here?
I'm kind of agreeing that in the very near term, we can have a very vibrant economy, given the stimulus in place, given the very low interest rates. But I also agree that the longer term is much more difficult. The longer term, you're going to have to keep that stimulus going if you've not fully repaired the economy. We will need to see a meaningful increase in employment in order to keep the US in sufficiently good shape. And we also need the companies back investing in their own businesses and not buying back their stock and doing wasteful dividend increases.
And Wakas, does the Fed have enough ammo left, or what ammo does it have left to prop up the US economy?
Actually, that's a question not just for the Fed, but for central bankers across the world. They are literally, trying to be more and more innovative. The Fed, yes, has toyed with the idea of quantitative easing beyond the existing measures. So that would be yield curve control as well, which countries such as Australia have introduced as well. But again, the argument remains that, yes, how much can it just do on its own? It will have to go with fiscal policies, because again, the shock this time, the recession this time is not just the financial sector, it's actually a supply shock, and it's also a demand shock. So you have shocks on both sides. So it's a rather unique recession in its own kind.
To Waka's point earlier about the Fed, is that most investors believe that even though stocks don't look historically attractive, the fact that the bond market looks so terrible make stocks attractive. Two wrongs don't make a right. And the idea that the Fed will be there always to protect equity markets instead of just dealing with liquidity in the credit markets, we think could be a damning problem for investors, especially in places like Singapore, where investors there are going to go to the US for two reasons. One, broad equity diversification in US markets, the S&P 500 notedly, or going out and buying the greatest American businesses, which puts them in very expensive multiples. And many of those are the work from home stocks that have absolutely been bid up in this pandemic episode.
So we'll take a short break, but when we return, we will talk markets and how the elections will affect investors in Asia. Welcome back to Money Mind's special virtual edition on the US presidential elections. So in this segment, we take a look at the market and geopolitical implications. Cole, we're going to start with you. In terms of the stock market, would you say a Trump or a Biden presidency would be better for returns?
I don't think the presidents can change the forward returns. I think where the money ends up getting rewarded will be different. As an example, President Trump has been incredibly vitriolic and outspoken on the US drug companies and how they price drugs in the United States versus how they get priced outside the United States. So I think a Trump presidency would be a poorer outcome for those kind of companies. In comparison, in a Biden presidency, Biden in the final debate finally told everybody that he would not allow fracking on federal lands. And I don't think that was in his best interest to say that, but the outcome of that will be, yes, they will limit the pumping of oil on federal lands. But if you think about that, it means that anyone already pumping oil on those lands become worth more because there's now a scarcity being produced. It also wouldn't be a shock to see financial regulation kind of creep back up, but either presidency will produce one thing, in our opinion. There will be regulation on big cap tech at levels we've never seen in history since Standard Oil being broken up and eventually busted into little pieces in the early 20th century.
But Gary, surely a Biden White House would present some new opportunities. What would they be?
For Biden, who comes with green credentials, people will be looking to the renewable sector for some further opportunities for investment. Having said that, many of them have run very strongly over the last 12 months. You've seen some renewable energies up stocks up 70 to 100%, and some of the ETFs that reference them are up 50% as well. The broader theme, though, I think is one of spend on infrastructure. And if you look globally, infrastructure stocks have not fared as well. And in an environment of very low interest rates, that is a sector that typically does well. So maybe there's a bit more oomph in the infrastructure sector rather than renewables.
Wakas, this is potentially a topic that you get quite passionate about. The relationship between the world's two biggest economies, the US and China. How do you suppose things could change post-November 3rd?
So views about China are unlikely to change in the mindsets of American people. What might change is the way they deal with China. So yes, Trump has his own ways, and we have seen how he acted in his first presidency. Biden might try to change some of those actions. He might try to forge stronger ties with his existing allies. So at least it can be more of a concerted effort. It can be at least more concrete in the way they approach the issues such as intellectual property rights or such as human rights issues that China violates in parts of its country.
Gary, if we look towards the US elections, what would be a good investment strategy at this point?
To be honest, I'm just sitting here, really sitting on the cash that we have and thinking about ways of investing into any noise we get. Certainly, if we were to see any substantial downside, I think investors will be in buying. I think, quite frankly, that people are already positioned for noise and trouble at the election because we're hearing out here in Asia of quite significant cash balances and very defensive policies ahead of the election.
Cole, I'd love to hear what you think as well in terms of investment strategy.
Whether it be the politics or the pandemic, this has created wonderful opportunities. So first off, for Singaporean investors and Asian investors in general, speculative risk-taking and broad diversification in the United States looks terrible. I just want investors to be completely aware of that. But if people are willing to be very concerned about the businesses they own individually, the energy market provides an incredible opportunity. Other places that are tied to the economy, consumer-oriented businesses and economically sensitive areas like home building. Demographics are in favor. We have great 18 to 40-year-olds that are going to be consuming a lot more. Further out to that, if you look at the 10-year, we have a steepening curve that's kind of showing up. One thing we didn't mention earlier, Yasmin, either is the market's held up well. That tends to be pretty good for the incumbent candidate. it's almost kind of like suspended animations going on until we get to November 3rd. And then the question is, what are people going to own? And that's really kind of the fun part of this for investors like us, because we know people aren't doing all those things I just said looked attractive. And that's why we think their returns are going to be so poor.
And Gary, I'm going to go back to you. In case election results are delayed, how will Asian financial markets fare?
They're going to take the direction from Wall Street. My assumption is that the markets will be down on that, and therefore, markets out here will be trading down as well. But bear in mind that lots of Asian markets and European markets are still down 15 to 20% year to date. So, in fact, I would expect some outperformance from a Wall Street mini collapse.
Cole, tell us a little bit about the US dollar post November 3, and should there be a delay perhaps as well in results? Where do you see that going?
Well, I wouldn't pin it much on politics. The history of the US dollar is that when oil and commodities do really well, the dollar tends to do pretty poorly. And we've had a very strong dollar regime, which has in fact pushed inflation to be very low for the consumer. So looking at this, I'd say the dollar's likely to do pretty poorly because oil will do well, commodities will do well. Those will beat stocks, just like inflation will probably beat stocks in the United States. One other thing I would add, we probably peaked out US equity markets in early September. The speculative episode of the financial euphoria we saw as a firm, I do not think we will see again in 10 years.
Gary, would you like to comment as well about the outlook for the US dollar?
I think in the investor's mind these days, we're starting to see that the dollar is no longer omnipotent. And therefore, when they're looking for diversification, they're not so concerned these days about retaining their dollar balances. And there are other currencies, as we've seen with the Swiss franc and the yen, for investors out here in Asia, where people prefer to park their cash. I'm not expecting a dollar collapse, but equally, I don't expect it to be moving much higher from the recent lows that we've seen on a trade-weighted basis.
So with that, we've come to the end of our Money Minds special virtual panel on the U.S. elections. And I've been speaking with Gary Dugan, CEO of the Global CIO Office, Wakas Adanwala, Asia Analyst at the Economist Intelligence Unit, and Cole Smead, who's President and Co-Portfolio Manager at Smead Capital Management. Thank you, gentlemen.